Morning, good afternoon, or good evening if you join us from Asia. I'm Nicolas Veron. On behalf of the Peterson Institute, it's my pleasure to introduce this session of the Financial Statement Series, a series which is nearly a year old because we had our first session on June 10 last year, so it's almost an anniversary. And today we're going to talk about capital flows, cross-border capital flows, and especially between the US and China, but more broadly with attention to the role of tax havens and attractive jurisdictions. This is very much in the news. So for this, we're going to have a conversation with Brent Nyman and Joe Gagnon. Brent Nyman has led a pioneering initiative to map cross-border capital flows, which will be very much the substrate of our conversation today. He studied at University of Pennsylvania, got his master's there in 1999, then at Oxford, where he got a master's in mathematical modeling, and at Harvard, where he got his PhD in economics in 2008. And since then, he has been at the Chicago Booth School of Business, where he's Edward Eagle Brown Professor of Economics, and also the leader of the Global Capital Allocation Project, which is where the research he will present, I guess, originated, also involved in a number of research initiatives at Chicago Booth, but also with a policy background. He's been staff economist for international finance at the Council of Economic Advisors, and also worked at the Chicago Federal Reserve. Joe Gagnon has been, of course, a fellow at the Institute for now some time, since 2009. He studied at Harvard, got his PhD in economics at Stanford in 1987, and then had a distinguished career at the Federal Reserve in Washington, D.C. as a senior economist, and lately as an associate director at the Division of International Finance and at the Division of Monetary Affairs. Meanwhile, Joe also taught at the Haas School of Business at Berkeley in the early 90s, and had two stints also in the 90s at the US Treasury in 94, 95 and 97, 99. So we're a bit more macro than usual today, but with attention to where the money flows. And on that, I'll give you the floor, Brent.
Thank you. Let me start by sharing my screen. And can someone confirm for me that they're able to now see my slides? Okay, I see a thumbs up. Great. So let me jump in. And thank you for the wonderful introduction. I do just want to also emphasize, though, that this work is joint with my co-author, Antonio Coppola at Harvard, and then also my co-founders of the Global Capital Allocation Project, Matteo Maggiore at Stanford and Jesse Schrager at Columbia. And, you know, when I was in grad school, let's say, and I'm thinking about the benefits of a country opening up to international capital flows, a country like Brazil, let's say, I would have had a picture like this in mind. I would have thought to myself, you know, here's, I don't know, a company like Petrobras. They run a capital intensive business. They might very well benefit from essentially importing capital, borrowing from Americans, you know, from Europeans, from the rest of the developed world. And this is at least how the map would have looked in my head. Somewhat recently, my co-authors and I put together a micro data set, a data set that looked at position by position holdings of funds and mutual funds domiciled all around the world from Morningstar and other sources. And what we found that we thought was quite interesting was if you actually quantified those direct flows, the extent to which the Brazilian firm Petrobras was borrowing, was essentially placing bonds directly into the portfolios of Americans and of Europeans, you know, it basically wasn't happening. The value in our data there was zero. So is it the case that, you know, Brazil and Petrobras are not borrowing from Americans or Europeans, at least their corporate sector? And the answer is no, they're just borrowing in an intermediated way through affiliates that oftentimes are located in tax havens. And in this particular case, one of the key subsidiaries is this Petrobras International Finance Company, which is in the Cayman Islands. let me pause for a second. I see a comment. I cannot see Brent's screen. Is that a common comment, or maybe I can ask Nicholas, are you able to see my screen still?
I see your screen, and I would assume that most people can see it. Jessica, can you confirm?
Okay, I see another participant said that they can see it, so I'll keep
going. So go ahead.
Okay, terrific. And it turns out that this international finance company of Petrobras, located in the Cayman Islands, is where we see a lot of the bond issuance that's ending up in the portfolios of these Americans and European investors. So this is really a very common phenomena in international sort of borrowing and lending markets. And one of the problems is, if you wanted to study how capital flows are, how capital is allocated around the world, who is lending to who bilaterally, this becomes a big problem. If you look at the US aggregate external position, a very large share of it is allocated toward the Cayman Islands, for example. And this has been well known. That's not our finding. But one thing that we do in our project is suggest a way to reallocate those positions and actually uncover, which ultimate parent company and which ultimate parent country, if you will, is really doing the borrowing in those cases. And so that's what our project does. To try to keep it quick, let me just give a very brief overview of our methodology, and then I'll jump to some of the key results that we see. But the basic idea is we use a bunch of commercially available data sources to link affiliates and parents around the world. So let me give this example I just gave earlier, Petrobras International Finance Company. This is a Cayman Islands resident firm. And so bonds held, let's say, by the French, issued by Petrobras International Finance Company, will show up in the IMF's Coordinated Portfolio of Investment Survey data as a Cayman Islands investment. But we will use data sets like CUSIP Global Services, Capital IQ, Deal Logic, et cetera, to connect this subsidiary with their Brazilian parent. Another good example would be Gazprom, which is a Luxembourg subsidiary of the Russian energy company. And so based on those mappings, which we do using a variety of criteria, that mapping comes from looking at things like the ownership sequences in some of these data sets. In other data sets, it can be about sales, employment, location of operations, et cetera. There are slightly different criteria across each of these data sets that we use, but we put them together, we form this mapping, and what that then lets us do is create what we call reallocation matrices. And this is the most technical part of the few minutes I'm going to give here, so bear with me, but I think it will be clear. For any given year, for any given asset class, and for any given investor country in our data, what we do is we ask what share of investment in a given destination, when measured by residency, which would correspond to the Cayman Islands in the Petrobras International Finance case, should, using our mappings, be reallocated elsewhere. So if we look, for instance, at this Cayman Islands row, what we find is that 20% of all US corporate bond investment in companies that are Cayman by residence should be Brazilian by nationality. And the Petrobras example would in fact fall as one part of this 20.1 calculation. So we do this for many different countries, many different asset classes, and we get results. We're able to essentially restate bilateral investment position statistics provided for the United States by the Treasury International Capital data, and for every other country in our data by the IMF's CPIS data. And we find a bunch of patterns. I'm going to highlight two key ones given this very short talk. But one is we find that the investments in corporate bonds issued by Brazil, Russia, India, China, South Africa, the BRICS countries, is vastly larger when you pass through tax havens and consider the ultimate issuer as these countries than what you'd get in the raw or sort of naive or kind of residency-based data. And this is quite broad-based. I mean, you can see here Australia it looks like about 1% by residency of their external bond portfolio should be associated with the BRICS. That's what this red bar at about 1% is. And you can see it's almost a quadrupling of that exposure when you instead associate companies like Petrobras International Finance, the Cayman's financing affiliate, with its Brazilian parent.
Sorry to interrupt, Brent. I think the country codes are pretty self-explaining, with the possible exception of CHE. What is CHE?
Switzerland.
Oh, okay. Yeah, I should have guessed that. Thank you.
No. So, okay. I won't go through in detail this kind of flow, but for those practitioners or otherwise that are interested in seeing the full sort of network of how countries source or access foreign borrowing via affiliates in tax havens, we're able to produce, and on our website we offer many plots of this kind. So take, for example, this is going to be how European investments in corporate bonds end up with Brazilian or Chinese or Indian parents. We're able to show that it all comes through, let's say for India, through their Dutch subsidiaries. That's this green line here. So again, I'm going to move quickly, but you can trace out.
And again, on acronyms, when you say Europeans, that means Eurozone, right? Because
I mean Eurozone. You're correct. You're correct. Not European Union. Eurozone. That's right. A second pattern, which I wanted to make sure to get to, given the title of today's session, is that we find a dramatic reallocation, an enhancement of equity exposures from developed country investors to China. You can see here that the United States, for instance, if you just look in the raw data, in the tick data, it looks like something like 2% of our external equity portfolio is allocated to China. And that's only about 1/5 of what we get when we associate, all of the tax haven equity issuances around the world that are associated with Chinese parents with China. And again, this is not a US phenomenon. Proportionally, you can see the changes even greater for countries like Switzerland or Denmark. It's a little more muted for Great Britain. There is cross-country heterogeneity in the extent to which this is happening, but it's massive. It's on a very large scale. Very quickly, and I would be happy to discuss this later, you might wonder why on earth is the equity exposure to China surging when you reallocate away from tax havens in the way that I've just described. The answer is there's a tremendous amount of equity or value of equity issued via the Cayman Islands for companies that have a so-called VIE or variable interest entity structure. And this is, of course, not, again, our original finding. This is something that's gotten the attention of a lot of legal and accounting scholars, for example. Companies like Alibaba or Baidu or JD or Tencent, these are not esoteric examples. These are, some of the major national champions we're all aware of. They structure themselves using this VIE structures where the issuing entity is resident in the Cayman Islands. We can talk more about it, but one reason they do it is to get around capital controls that otherwise might prevent foreign ownership of the operations in China in these protected industries. The last thing I want to show you is just how important this different notion of, sort of ownership and exposure can be in terms of creating a picture of the overall relationships between countries around the world. So here I'm going to show three different notions of the US exposure, or I should say China's share in the US equity external portfolio. The red line is what you'd get if you just started with the Treasury International Capital Statistics and just asked on a residency basis, what share of all foreign equity investment by Americans goes to China? And you get a very stable and low pattern. It's somewhat surprising in that sense, at 2 or 3%. This has been, for example, the topic of op-eds in the New York Times, in the Financial Times is the one at least I have in mind, hedge fund managers sort of puzzling over why, despite China's huge share in the world and in the global economy, advanced economy investors might be so underweight in terms of their exposure to these companies. If you instead use the nationality basis that I just described, where, for example, you would consider Alibaba as a Chinese equity position, not a Cayman Islands equity position, you get a different picture. You get a much higher exposure, starting at 5% in 2007 and doubling essentially to 10% by 2017. One thing we do further in our paper is consider a sales-based notion, where we take the portfolios company by company and allocate them to potentially multiple countries based on the geographic distribution of their sales. That's yet another potentially interesting way to think about the relationship, let's say, between the US and China. And what that measure gets us, yes?
Just for clarification, the green thing means you add also Chinese revenue of General Motors and IBM and Apple?
Correct. If 10% of General Motors sales are in China and General Motors is 1% of the US equity portfolio, this would count toward that at 1%. That's right. And you get, of course, unsurprisingly, a much larger, but also more steeply growing exposure, reaching something closer to 15%. Much closer to estimates of the share of China in the global economy. And so the broader point here is that I think using microdata and analyses of the kind that we've used, and I should note that all these analyses are available for download, for modification, for practitioner and researcher purposes at this website, globalcapitalallocation.com, you're able to paint a richer picture and sometimes reach somewhat different conclusions than what you otherwise might get from standard bilateral investment data.
Thanks so much. And over to you, Joe.
Oh, okay. Well, thanks, Nicolas and Brent. That's a really great presentation you made, and I really enjoy this work. It's very useful, it seems to me, for people in this area, and the results are very sensible. And they're sort of, I wasn't very surprised by your results because I'd seen, for example, Brad Setzer used to look at Chinese investment in the US, so the reverse of what you just did, and showed that the data suggested it was flowing through Luxembourg and London and Cayman Islands. And so we sort of knew that kind of thing was happening, but to actually have a good measure, so comprehensive, and have the data available to people is really a great service. I do kind of, I don't know, I just, since I totally had no disagreements with anything you did, I thought it was useful. I don't want to criticize it really, but I want to maybe just make a few observations and then we can have a discussion. But so one thing, and this is no particular order here, I just jotted down a few thoughts, but this is driven by tax concerns, tax accounting concerns, really. And do we think the G7, growing G7 agreement now on minimum tax and maybe future cooperation might change this going forward? I really haven't given that much thought, but it certainly is an obvious thing to think about. I actually haven't read the G7 text on this, and I'm sure it's going to evolve over time. They still have to hammer out the details. A couple, I think one thing, I guess I would have thought, and you show it's not really true, but I would have thought that one thing about this is that if you look at countries' multilateral positions, their overall international exposure isn't much affected by this because this just says it reallocates where things go. However, that's not quite right, because as you said, with the Chinese VIE structure, there's an issue, becomes an issue of valuation, that the assets don't get revalued to mark to market because of the way they've been reallocated into a different category, which is unfortunate. So in fact, it means that not only are the bilateral patterns screwed up, but even the multilateral patterns aren't measured right because some of them aren't revalued. Then it does also raise the tremendous riskiness, it seems to me, of this whole VIE structure in China, but I guess that's really not your main point. So I don't want to go there too much, but when you listening to you present this, it reminded me that that's a big issue, it seems to me, that needs to be tested at some point, will be tested at some point. And shareholders might find they don't have the ownership they thought they had. So then two final questions, very sort of minor specific questions. One is, I was trying quickly to look as you went by sort of how US investment through these havens is allocated to the BRICS, and whether that was any different from how EMU investment was allocated to the BRICS. And it looked actually reasonably similar, which brought up the question of how far off would you be if you took, say, the IMF CPIS, Coordinated Portfolio Investment Survey data, to the extent that it's available for some of these tax havens. And I guess one issue is maybe some of them don't report, but if they do report, Caymans did report, and you looked at where Caymans is then holding assets, how bad would you be if you just use those allocations to attribute to the US ultimate ownership? But maybe the point is that, well, what US invests through Cayman is not allocated the same as what Europe invests through Cayman, and therefore what you've got is real value added. If you have any thoughts on that, that would be great. And the final point is, one of the issues, because you're talking about China, but again, this is in the other direction, but China has a big current account surplus and I think net FDI inflows still, so that it's got a lot of money coming in, and increasingly bond income, stock and bond inflows too, and yet the renminbi isn't going up very much. And what you see, if you look in the thing, is big outflows, both from banks on net and from errors and omissions. Is there anything that you're doing, if you look at where China's assets are going out, that would give you any hints as to what's going on? Is this driven, is this a policy, is this stealth intervention by the Bank of China? And is there any way we would know it based on where it's going? Because obviously it's not showing up at the PBOC, People's Bank of China reserves or anything, but it's showing up in state-owned banks, for example. But it may just be Belt and Road type stuff, which would be interesting to know, or is it something else? I'll stop there.
Thank you very much, Brent. Do you want to answer some of the points that Joe raised, since they were raised as questions?
They were great. I'm happy to tick through and respond to a lot of those if that works, and tell me if otherwise. But let me reshare my screen, because one thing Joe spent a good amount of time on in his comments just now, which I think is quite helpful, is this VIE structure that, again, I mentioned but might not be clear. So hold on one second. Let me make sure I can do that.
So VIE, while you're searching for slides, is variable interest entity. And indeed, it's a kind of structurings that essentially all Chinese companies use when they issue securities for foreign investors.
Yep. So let me, are you able to see, I assume, this, why are Chinese firms doing this, Nicholas? Is that correct? So this is not a VIE. This would be a standard structure. Let's say we're thinking about foreign investment into China, where there's no controls, and it's just direct, in the same way that a foreigner can buy a share of General Motors stock, a US company's equity. Imagine that Americans bought a share issued directly by an operating company in China. There'd be nothing fancy here. You'd have ownership crossing the inside-outside China border from foreigners, and you'd also have ownership directly from the Chinese. But this, of course, would violate any notion of restrictions on foreign equity ownership of this operating company. So what's instead done is this VIE structure, which I put here, has been created, where there's essentially a number of intermediate steps breaking the link, between the foreign shareholder and the operating company. The way I would start in describing this is first, there's something called a wholly foreign owned equity, or it's referred to as a WFOE, WFOE here, which ostensibly controls, it manages the operating company, and it's entitled to something that approximates the cash flows from the operations of that company in China. But the relationship is not one governed by equity ownership, it's instead contractual. So there's, for instance, power of attorney granted by the operating company to the WFOE, things like this.
So the WFOE is a Chinese corporation, right? It's incorporated into mainland, that's where it lives.
It's a Chinese resident company, but the key is that you can think of it like a consulting firm.
Yep.
At least that's how I like to think of it. If it's a consulting firm managing, let's say, the telecommunications or internet firm, even though the telecommunications or internet firm might be in an industry or sector where foreign investment is restricted, the consulting firm, this WFOE, is not. And so there's no problems, no violation of that control, that there's some listed company here, which you can think of as Alibaba in the Cayman Islands, which owns that WFOE. And then finally, it's the foreign shareholders, which actually own that listed company. And so it's this sort of roundabout way where, in principle, the operating company can talk to the shareholders and say, look, you're getting a claim on our cash flows because it'll flow to the WFOE, which is owned by the listed company that you just invested in. On the other hand, they can also say to regulators that the foreign shareholders don't directly have an equity stake in the operating company. And the reason this is relevant,
Wait
yes.
a minute, before you move to the next slide, sorry for spending a little bit time on this. Can you show the previous slide?
This is the exact same one, just with two annotations. Do you still need me to go back, or might you be able to?
Because you had a special purpose vehicle in the previous one.
Okay.
And I'm curious about that one.
Well, I really don't have anything to say about it other than to try to have a little more fealty to the way in which these structures are actually exist in the world. Some of the viewers.
The message here is, if this looks complicated to you, don't worry, the reality is much more complicated, right?
Correct, that's right. So much more complicated. In fact, in the appendix to our paper, we show the reporting of this structure, a version of this picture for Alibaba. I believe we still show it in the appendix. If not, you can find it in some annual reports from Alibaba. And there's going to be vastly more lines flowing from listed company, which is the ticker BABA from the Caymans, through any number of SPVs in Hong Kong, for example, all over the BVI, through to the WFOE.
So basically, if you own Alibaba shares, you own a number of different things which are much stranger than most of the owners realized. And what you don't own is the Alibaba company in China.
Well, you own this listed company in the Caymans, which has a claim through all these intermediaries on the WFOE, or through all these complex linkages on the WFOE, which has this contractual connection to the operations in China. That's correct. That's correct. So let me just finish the point by just kind of quickly noting that you might say, okay, but for at least the sort of macro purposes that we've been thinking about, why is any of this relevant? And the key is that had the structure simply looked like this on the left, where foreign investors simply bought shares in the Chinese entity, it would have been classified as a portfolio investment. And its value, since these are publicly traded companies, very sort of easy to see changes in the value of the equity, they would simply move up or down with the stock price. In the same way that if, a Mexican citizen owns a share of General Motors stock, and General Motors stock doubles, well, then the value of US equity liabilities to Mexico, goes up. It's pretty straightforward. Instead, because this is the cross-border link now in the VIE structure, and that linkage is between a company that then wholly owns its affiliate in China, this is treated as an FDI, a foreign direct investment position, not as a portfolio investment position. And there's a variety of rules, and we certainly don't see any evidence that the rules aren't followed or anything like that. So that's not the claim. The claim is simply that with FDI, there's more scope for the valuation of the position to not move in lockstep with the equity valuation. And that's kind of what we're trying to show with this slide here, which shows that even though the actual market value of the VIEs during this period from late 2016 to early 2018 goes up by something like $1 trillion, the reported FDI that in principle should capture that is basically flat.
So, sorry, this is quite technical, but I guess that's where the juice is. So we shouldn't be defensive about it. If you stay in the chart you were just annotating, the one with share prices versus FDI, why is it that the FDI line, the blue line, was so much higher than the market value line until recently?
Yeah, so it would not have bothered us had the line, and let me clear this out a little bit, had the blue line looked, something like this, we would have said, okay, that's perfectly natural because, of course, there's plenty of FDI from Hong Kong to mainland China that is not associated with the VIEs.
Oh, that's why. So that's
so there's no reason, these are not identical concepts. The key thing is, this increase, we believe, should show up somewhere in China's foreign liabilities. The blue line captures the place that we most naturally believe it should show up. This is a bar chart that shows you, for instance, this red line, the increase in the market value of these VIEs. And this just tries to show you sort of exhaustively all the different liability categories from China, where it could plausibly show up. We think it should show up here, but it doesn't appear to show up anywhere. And I bring all this up because Joe's second point, which was absolutely correct, is, most of what we are talking about is about bilateral stuff, not multilateral stuff. For instance, if the US buys a bond issued by Petrobras's financing affiliate in the Caymans, and then the Caymans financing affiliate does an intercompany transfer to Brazil, Brazil's multilateral position vis-a-vis the rest of the world shouldn't be affected. It's just that the US bilateral exposure shouldn't be associated with Caymans, at least for some analyses. It should instead be with Brazil. Okay. But this is the one spot where the multilateral position, namely that of China, might be affected because the way in which you account for FDI can differ from the way in which you account for equity investments, portfolio investments. And this complicated structure through tax havens around the world has the effect of converting what might otherwise be considered an equity investment into an FDI investment.
So there's a lot to unpack here. We have a number of comments in the chat about VIEs, variable interest entities. And let me also remind everybody that FDI is foreign direct investment, a very important statistical category. So this is not a session about VIEs. We may have another session about VIEs because it's so complex and so important. But I suggest we skip the VIE stuff right now and go back to your core observation of capital flows. I have two questions which are kind of formal. There's an anonymous attendee which asks, do any of the presenters have a conflict of interest, such as getting funding or receiving payments from China? For Joe, I can answer because this is PIIE and everything is in our reporting on the website. But Brent, do you want to answer that one?
I can answer for myself. No, I don't receive any funding from China.
Very good. A question from Zhengxin Li from Caixin in China. Your observations, at least in one of the charts, stop in 2017, and there's a related question from Sam Jordan on the effect of the investment ban and also what President Biden just announced. Do you think that what happened during the Trump administration and also some more recent initiatives of the Biden administration would change the trend if you had the data for more recent years, or you just don't know?
This is for me, Nicholas?
I'm afraid.
Sure. I mean, so I mean, this would get a little bit to what Joe's first point was, for instance, about the G7. And the question is, the G7 tax initiative, the question is what's driving the accessing foreign investors via tax haven affiliates. And there's lots of different forces that could be driving that. So I've told a story for a number of Chinese firms. We believe that the driver of this is the capital controls, the restrictions on inward foreign investment. But there's other features. There could be the desire to minimize corporate taxes. There could be the desire to minimize withholding taxes or the impact of withholding taxes from the perspective of foreign investors. There are regulatory differences. In the appendix to our paper, we discuss a number of these issues. A lot of the reforms on the table, including, for example, the G7's discussion and potentially the G20's discussion of the international tax reforms, to the extent they affect any of these incentives, then yeah, one would at least potentially see less issuance occurring via these foreign affiliates. It's too early to know whether any changes actually have occurred. In our data, we have not yet updated beyond the 2017 vintage.
So if I take a company which is a Chinese company which is listed in China, like say ICBC is a big bank, is there any impact of your research on this one, or would the flows of investment into that company, unlike Alibaba, which is listed in New York, be properly accounted for by the traditional statistics?
So I don't know the specific case you gave, but the key from your question is where the firm is listed is less relevant for the concepts that we've been describing than where the issuing entity is resident. So for example, you're right that Alibaba could be listed in the United States, but the key is that it's resident in the Cayman Islands. And so that's why for the statistics that we're describing, that's the relevant notion.
But for a company which is, for those Chinese companies, and pardon my ignorance, which are listed in Shanghai, the big SOEs, state-owned enterprises, which are listed on the mainland, would they also have foreign vehicles issuing shares, equity securities abroad?
So, bonds are going to be a little different from equities in the sense that, you could have many issuing entities entering the bonds.
In Luxembourg and elsewhere, but
the equity, which is usually just, one entity sort of issuing equity at the sort of top of the corporate structural pyramid, if you will. The key is where is the location of that entity. And so my understanding is if you have a Chinese headquartered firm, if a firm is headquartered in a given country, then the investment statistics will treat equity investment in that firm as associated with that country, independent of where the actual shares are listed or traded, including in multiple jurisdictions. You could be traded in multiple markets.
Yeah, well, maybe something to be checked there. There's a question from Christian Chavagnier. Is all this done for tax or regulatory issues or both? I think you just answered that. Christian, if you want more, please ask more. So I also have plenty of questions, but I guess one basic one, which actually was asked by Josh Kirschenbaum in advance of our session, because he's on the West Coast, is will official statisticians catch up? I mean, are the folks in, multilateral institutions, the OECD, the International Monetary Fund, the Bank for International Statistics, whatever, or in national statistical bodies, the Treasury, the Fed, whatever, can they basically replicate your work and make it official? And will they?
So, first, I just want to sort of place our work in the proper context. First is this general issue, the idea that a lot of, companies are accessing foreign investment capital via offshore affiliates, and this, distorts in some sense, makes more difficult the analysis of these bilateral investment data, has been studied, and there's been a lot of work on that, well predating ours. The BIS, for example, is played a real leadership role there. Also, some official entities, in particular, in the United States, in the Federal Reserve, there's very nice work, for example, by Carol Bertout and Stephanie Kurkuru, and there's a team of researchers putting out, from the U.S. perspective, very similar restatements that have very similar themes. And so, yes, I think there is a lot of high quality work done by the official statistical agencies in this direction. One key reason why we're excited about this contribution, even relative to some things that the official sector, will be able to do, is we can, I imagine, unpack the data or offer some tools that span multiple countries that allow the user to download sort of the micro level drivers of the adjustment, put in your own choice of what countries would be considered tax havens, restate things in many different ways. For example, choosing to only reallocate things that have been issued from tax havens, or instead reallocate things issued anywhere. For instance, you might want to associate a US investment with Toyota North America as Japanese. Part of what we view our contribution as is offering, sort of that broader set of tools and an integrated view across countries that I think is likely to be unique to academics.
But I guess my question and Josh's question was, in a way, about the divide between research and statistics, right? What you're doing is research. What the Federal Reserve people you just mentioned are doing is research. But when does that get into the blood flow of the official statistics, which would enable many more people to get the correct picture, if you allow me to use that kind of vocabulary, much more naturally?
I think the way I would think of this is these statistics offer an answer to particular questions, and different questions demand different treatment and therefore the production of different statistics. I don't want to claim that the residency-based notion, which is the standard used in, for instance, the CPIS by the IMF, is kind of incorrect in any sense. It's an answer to a precise question using as precise as you can get a notion, which is the residency notion. To the extent there's enough sort of coalescing around what the key question of interest is, such that a particular standard for residency or sales-based or tax haven only residency, all different notions that we present in our paper, to the extent there's a generic and broad-based need or agreement on which notion is the most useful, then yeah, I would absolutely expect the IMF and the BIS and Treasury to at least head in the direction of providing statistics consistent with that notion. But until you get there, I think the proper thing is for researchers, like you said, to be providing multiple different versions that can be used to answer different questions.
I mean, the bank for sorry, Joe. Yeah, sorry.
On this point, just to restate, this is a question I raised, but it relates to this. So just to, I'm curious to know if you think, to the extent that the official statistics already have this kind of locational information. So the IMF has the coordinated portfolio investment surveys, and so you can look at the tax havens and you can see where the money comes in and where it goes out. So one could create an approximation to what you're doing using that. So you'd say that US money is going into Caymans, but then it's going out to Brazil. We see that in the IMF data already. How bad is that an approximation? And I think the answer, I guess, would be, you could tell us, if the way US money flows through Caymans is very different from the way European money flows through Caymans, then that's not a very good answer, and what you're doing is better. But do you have a sense?
Yeah, so the answer is, for a lot of purposes, we believe that it will matter, that you can't do what you suggested. The simplest way to show, and I don't want to overstate it, for some purposes, if you just want to get the general idea, if you just want to make an assessment that, countries are more exposed to China than you might see in the raw data, you're going to be able to get that generically. But a simple way to show the point, and we have done this analysis, it was helpfully suggested, is to think through that what you're suggesting would imply the identical proportional adjustment across countries. In other words, if we assume
one slight difference, you're putting together all these tax havens, but what if they each specialize in a different country? So, because Caymans might go to Brazil and Luxembourg might go to Russia, and therefore you're losing that information.
So again, I mean, take China as an example then, where I'm not aggregating, if I understood your point correct. So to do what you're describing, which is take the asset side from those tax havens, which you're right, is not always available in CPIS and all that stuff. But in some of these countries, it is available. And if all countries around the world had the same portfolio of, let's say, equities issued by Cayman Islands resident firms, then in that scenario, the right adjustment would be the identical proportional adjustment across firms, across countries. And you can see here that the adjustment is on the order of 5 times for the United States. It's less than half for Canada. If you took the Canadian ratio and made it for the United States, you'd miss hundreds of billions of dollars. Joe's right that this is a little more complicated what I'm showing you here, since I'm aggregating across all the BRICS issuers. But again, for Norway, you see essentially no adjustment here. For Sweden, you see a massive one. So
you're also aggregating across tax havens. Again, if Caymans focuses on Brazil and Luxembourg focuses on Russia, your graph smushes that up. And I'm wondering if people do the separately by tax haven, is that close enough? Like, do all investors?
It is not. I mean, it depends on what your purposes are. Let me go back. This was this first sort of slide I showed. This is really China through Caymans. If you want to, the bite of it. Like I said, Tencent, Alibaba, Baidu, JD, they're all Cayman resident firms. So that's what's driving this. So this does directly exactly answer your question for this case. To get beyond that, you could do the analysis, and we have, using, for instance, this flow chart you're sort of suggesting, or, I mean, you can even see it a little bit here. South Africa, European investors into South African firms are doing it largely through other tax havens, meaning countries that we consider tax havens that are not BVI, Caymans, Ireland, Luxembourg, or the Netherlands, whereby in the US case, actually, the major way in which South African corporates access US investors is through the Netherlands. So there would be another sort of good example. So I totally agree that that's the right thing to think about. We did. It does look like there's additional sort of benefits from doing this kind of properly.
There are a number of questions about that. Gavrav is asking what's your basis of classifying a territory as a haven in the study, but I guess you kind of answered that by saying you give all the details and then people can make their own judgment on what they want to label a tax haven, right? But in the slide you just showed, for example, for EU or also US investment into Chinese securities, equities, there's a lot in Cayman, but there's also a sizable chunk in the British Virgin Islands, the BVIs. Do you have a sense of what drives the differentiation between Cayman and BVIs? What is the respective specialization between those two sunny places?
Yeah, no. So look, I mean, I don't know, when I first applied to grad school, like you said, I sort of came from a math background, and the goal with math is you answer questions and you sort of shut down the leads in the literature. With economics, success is you open an area, and this is definitely one place where we hope there's a lot of follow-on work. Some stuff clearly shows up as just geography. So for instance, the British are vastly more intensive users of the Channel Islands, where a bunch of water utilities, Thames, I'm getting the names not exactly right, but a bunch of British water utilities issued bonds through the Channel Islands, Guernsey, which are much more intensively invested in by the British than the Americans, for example. That's and right. Of course, it's so. But aside from just geographic proximity, there clearly are interesting differences that we hope either ourselves or others can shed some light on moving forward. The only thing I'll mention, just in response to the comment prior to the one you just said on how we choose the tax havens, I would refer to the paper for all the gory details. And like you said, our algorithm, which is open source, allows a user to add or subtract. But I do just want to note, it's pretty darn concentrated. In other words, as long as you've got the biggest ones, most of which I listed on that flow, Cayman's, BVI, Luxembourg, Netherlands. If you get the top 10, making changes below that aren't going to change very much, at least for the large countries.
So we had a long discussion about statistics, and Michela Nardo is making a remark more than a question. So official statistical offices, Eurostat, OECD, UNCTAD, among others, are well aware of the issue, and some EU countries are collecting data based on ultimate ownership of the investor. So, so that just to emphasize what you said, which is that there are many threads to this effort, and hopefully at some point official statistics will catch up. And actually, I mentioned, you mentioned, and we mentioned the Bank for International Settlements. They had this discussion decades ago for their banking statistics, where they issued two data sets, one by residency, the other by nationality, as you call it. But that was that were very tense negotiations. I know Ted Truman, who used to work at the Institute, had been involved in that. And actually, there are still some countries in the BIS which don't report their nationality statistics for banks. So it's a work in progress. I have a question of a different nature, which is asked actually by an anonymous attendee about decoupling. So there is this big debate about decoupling in the US. Should the US decouple from China? On the face of it, my impression from your work, and as you emphasize, it's not unique in there, but it contributes to a body of work that tends to indicate that the financial relationship between the US and China is larger than many people think, right? So is it correct to infer from that that decoupling would be more difficult than many people think, or how do you think about that?
There's a question what it means on more difficult, but it does suggest that the links, if you entered your analysis with a prior that the bilateral relationship involves the Chinese holding a substantial amount of US treasuries and the Americans having very little financial exposure to China. I hope our analysis sort of changes that prior and has you thinking much more about a more symmetric relationship where the US, if you take into account the value of its equity exposure to China, at least intermediated through these companies that have a VIE structure, it's much closer to symmetric in that sense. Similarly, the analysis that we talked about earlier with respect to the net foreign asset position suggests that the Chinese net credit position to the rest of the world is not as large as you might have thought beforehand. And so without getting into what exactly we mean by decoupling, how exactly decoupling would occur, and even what you mean by difficult, I do think it does change an evaluation of the bilateral relationship in that sense.
Joe?
I totally agree. I think the links at all levels are very deep. I mean, it's just not at all comparable to the Cold War or anything where we had almost no exposure to Russia and vice versa. Our economies are deeply linked, so it makes it far trickier.
There's a related question asked by Patrick Allard about the US government's effort to look at forbidding investment in some Chinese firms linked to the military. How is that effort affected by the kind of structures and flows that you describe? Is there a simple answer to that?
I won't have anything here to add on that.
Well, that's a simple answer of sorts. But yeah, I think one of the things that strikes me, and this is also reflected in some of the questions, is that there are very different levels of awareness of these things. And I think even in the investor community, there are investors who invest in VIEs with their eyes open, and they understand what they invest in. And many other investors invest in VIEs without any idea that they're not actually owning the operating company in China. And all these discrepancies in perception affect the broader policy debate, I think. Do you want to make any comment on that, which is a kind of broader kind of umbrella consideration?
Sure, and actually, let me, if I could just start, I'm seeing a little bit of the comments, and just to first acknowledge, Paul Gillis wasn't thrilled with the terminology I've been using, and he's right. The right way to think of this integrated structure, which I referred to as VIEs in the paper, we try to say it's a VIE structure covering the full sequence, which is what matters for our purposes, from the Caymans issuing entity all the way through to the operations, through to the contractual connection between the Woofa and the operating company. So I acknowledge that there's a little looseness there. But on the point that you made, one thing I like to note is that our data come entirely essentially from mutual fund and ETF holdings. These are exactly the kind of investors that you would least expect. It'd be one thing if the data showed that sophisticated, hedge funds, et cetera, were those that were accessing, Chinese equity through Cayman's issuers, and but our data from which we base this whole analysis actually shows that there's a tremendous value of these holdings directly in the mutual fund sector. And so if one is concerned, and people have raised the alarm bells about the vulnerability of investors, or the potential vulnerability of investors with these claims, then these are retail investors. This is held in your retirement investments and passive investment portfolios. And anyway, so I would leave that there. The only other thing to note is there has been a lot of work. There's been economist articles, PIIE notes, warning us about this issue. Where our work, I think, enters is a lot of times when these articles assess the scale of this issue, they underassess the scale because they're using the residency-based data. And so
I would just add, it reminds me a bit scarily of the sort of complacency everyone had with AAA mortgage-backed securities, thinking, the tranches are plenty to deal with any subprime issues, and everyone believed that until suddenly they didn't.
And there's a question in the chat from Osamu Onodera. If the relationship between the Woofa and the operating company is only contractual, how are investors protected? I guess the short answer is they're not. so that's a bit scary indeed.
Yeah, a Chinese court may just decide in the end, whoops, the regulator should never have allowed this to happen, and they're not legitimate, and that's that.
Exactly. So there's a precedent worth taking a look at for those interested in this issue, which is looking at the case of Alipay, the original payments system.
Exactly. And I should mention the research of our colleague Martin Schorzempa here, who has also contributed a lot to these to observing those structures. I'm looking at I'm looking at the clock. We're close to the end. I have a last question about the Belt and Road, it's a slightly different issue. The Belt and Road is a lot about tangible physical investment in infrastructure, but is there any connection between the Belt and Road Initiative and the kind of data that you're observing in your work, Brent?
I would only make it at the highest level, which is just to note that there's a number of reasons why it's getting harder and harder to figure out who owns what around the world. And you can imagine that being particularly important in the context of, stressed capital markets, among other sort of potential states of the world. And I would say that, there's increasing interest and concern with official lending that might not be disclosed, the way that we would most want for surveillance and for well-functioning markets. And I would put sort of the issue that I've talked about today in that broad category, that we need to invest more in figuring out who owns what around the world. That's
right. And here is a work by Anna Gelpern and her co-authors on confidentiality in sovereign lending contracts by China, and also by others, comes to mind. I have tons of other questions. There are tons of other questions in the Q&A. Thomas Timberg, for example, is asking about Asia. We have a number of questions about specific exposures and deals. Jens Bastian is asking about Tencent's stake in Tesla. We're not going to be able to answer all of these. Of course, there can be follow-up exchanges, including directly with Brent and his co-authors, But I want to really thank Brent and Joe for this exchange. To me, it's really illuminating. And we need to really have this kind of big picture in mind for all the debates about the US-China relationship, to the extent that the orders of magnitude are slightly different depending on how you correct for all these different specificities. Joe, any concluding words from you?
Just that I just think this is fascinating research, and it's just very valuable research. So anyone who cares about these issues is filling a gap.
So basically, we want Brent and his co-authors to keep up the good work. And in the meantime, many thanks for participating in this session to all the attendees, and of course to our two speakers, Brent Nyman and Joe Gagnon. Our next session will be on June 23, where we'll be talking about something equally nerdy, but equally important, clearinghouses, also known as central counterparties, and especially international clearinghouses, and how they're supervised and how that is undergoing change, not least with Brexit. Thanks very much to everybody for attending, and have a great rest of your day.
Thank you.